We'll put focus on the recent boom in the Chinese markets, the stellar rally that we've seen. But how can investors sitting in India can play it via the mutual fund route? Something that a lot of you have been writing in and talking about as well. So we'll get in our guest to answer that for you. Later on the show, if we do get time from this interesting topic, we will discuss the recent SEBI norms, including the approval to introduce a new asset class to bridge the gap between mutual funds and PMS. Radhika and Feroze, thank you so much for joining in today. And you know, this is a topic which everyone's been talking about, so it's good to get in your opinion as well. Feroze, first, what is the idea on Chinese markets and how do we compare it with India now? Because there's suddenly the China versus India debate as well.
Yes, Sonal, good afternoon and good afternoon, Radhika. Firstly, point is that China and India have at least from an Indian standpoint competing with each other.
Yeah.
From a global standpoint, India and China have not been able to compete. For somebody who's outside India, who does not have the India bias, they don't see India and China as the same. We do because we stay in India. But I think Chinese have reminded us about what they did in 2008 with this new stimulus. They had done almost about $570 billion of stimulus way back in 2008, which put them in a trajectory of a great growth for almost a decade and more, almost 15 years. And they didn't go through a recession, which the world went through. So I think it's a reminder of that. So like Radhika said, if you're taking a structural call on China, then using one of these funds to get into a Chinese market with a fund manager's eye on it is a great strategy. Point two, India and China. I think India, FIIs, if you look at the numbers of FIIs, you'll be disappointed of how FIIs have pulled out from India. Yeah. If you look at the full calendar year, you have almost about $22 billion, which is 1,65,000 crores exited till the September end. And they have been light on India ever since January. On the election day, FII index futures, election counting day, was at short 88%. Just last week, it crossed 80% on the long side. So point I'm trying to make is FIIs have not been so bullish India. They've been very bullish India small cap. This is one great trend which people are missing. Indian stocks which FIIs are buying are the small cap ones. So to answer your pointed question, I'm not too worried whether FIIs will pull out of India to invest in China. They've been pulling out either way.
Okay, and yesterday we saw 12,000 crore rupees, and you know that has been the single biggest number that we've seen in last 4 years. So you're right, that has been happening for a while. What about you, Feroze? What are some of the themes that an investor can play on when it comes to Chinese markets?
See, I think you have to play a very broader market. When you're going outside the country, I would stick to indices. Of course, the Edelweiss fund, like the Greater China Fund, has been offshore fund. It's a feeder fund. It has been in existence for more than 5-6 years. The first great part is you're discussing something, Sonal, I should compliment you, which has the worst rear view mirror. Right? Generally, when past performance is great is when these get discussed, right? Now, if you look at the Greater China Fund, for the last 3 years, it's given a compounded minus 13. So that itself implies that these are the times, the troughs to back that argument that there is value. So coming back to what themes, I would say you have ETF as one of your alternative, and you have these feeder funds also as an alternative, and you have LRS, which is the liberalized remittance scheme, as your alternative. These are your three alternatives. In my opinion, you can definitely look at the Hang Seng Index Fund, which is there. You can definitely look at the oldest Edelweiss feeder fund, because Radhika would be better poised to say how long has the feeder fund, the primary fund, been into existence and a track record. I think I would leave it to the fund manager, but I would prefer a feeder fund rather than only a domestic asset management company looking at China with fewer analysts. But if somebody is more deep-rooted there, that's much better, and that's what the feeder fund would do.
Okay. So two-part question for you now, Feroze. The 3 ways for mutual funds to take exposure to these Chinese funds, if you can repeat that for us. And second is some of the themes that you also think could work in the Chinese markets.
Yes, sure. First, let me address that bit, because a mutual fund manager. So the 3 ways are, one is not a mutual fund way, which is the liberalized remittance scheme, where you and I, as Indian residents, have the right to send almost about $250,000 outside every financial year per person in a family. So that largely the ultra HNI families end up using it. That's point one. But from a mutual fund standpoint, there are some feeder funds, like Radhika said, and she emphasized that that fund has been in existence for 23 years. But the wrapper fund is there for 6 years. So it's not just 6 years track record, but you have 23 years. Now suddenly changes the entire thing, and 45 people on ground. So one are these fund of funds, the others are index funds, which are there. These are the two, in which if I have to give you some names of the funds, there are two which stand out on China, which which is the Axis Greater China Equity Fund, and Edelweiss Greater China Equity Offshore Fund. These two are fund of funds, especially because of the tax change in this budget. These have become attractive. Otherwise, if I was going to pay marginal tax rate on an investment going global, so I'm taking the risk and funding the government if I'm going to just take the marginal tax rate. So that's a big advantage. If you come to the Hang Seng, there's one Hang Seng Nippon India ETF Hang Seng Bs, which are low cost and also invest in the Hang Seng Complete Index. There's also one, which is Mirai Asset Hang Seng Tech ETF. But I would definitely not recommend you to pick up only the tech stocks from Hang Seng, because you're anyways doubling up the risk if you do that. And in the LRS, of course, new energy and infrastructure and industrials is what I think I would be bullish on if you're such a large guy that you want to remit the money offshore and buy something domestically domiciled there. These are the two themes.
Okay, so these are the ways a mutual fund investor can go ahead. Let's talk about the new product, the investment product. This will be under existing mutual fund framework to bridge mutual fund and PMS gap. Feroze, let me start with you. This was discussed in July as well. There's still nothing concrete finalized here. Tell us, what is it different now versus what was in July? How would it work? And what are some of the key considerations that you think the regulator should also keep in mind?
Yes, so I think, Sonal, it's a very, very progressive step. Why? Because today you have some platforms available. So if this platform was a Me Too platform, then it was a useless one. So if you look at mutual funds and PMS, these are two prominent platforms, and people use also AIF for long-only positions today. These are the three platforms. Now this becomes the fourth platform called the investment strategy or strategy ka platform, whatever they actually finally name it. In mutual funds, derivative usage is only limited to selling calls if you have the same asset. If I have a Reliance share, for example, I can sell calls of Reliance share. That's called a covered call strategy is possible. You can buy puts and buy calls. This is what is available on mutual fund currently available. Then PMSs can use derivatives only for hedging purposes is what it is mentioned. Now people might take a little more aggressive stance as a manager, but this is what is mentioned. Now, so this is very relevant because the existing platforms don't permit usage of derivatives very well. And AIF is 1 crore plus. So I'm very excited about this, point one. Point two, if the leverage ratios are reasonable, because futures in India can get you, Nifty futures can get you 5 times leverage, options can give you 500 times leverage. So if the leverage ratios are as worse off as 1.5 times your capital, if somebody put 10 crores and can take a exposure of 15 lakhs, 10 lakhs, you can take an exposure of 15 lakhs, then it will not be exciting. It will not have any meaningful shift from the derivative market to this strategy, even at a mass affluent level. That's point two. Point three, I personally think that a lot of asset management companies have shared strategies with the regulator. I'm very happy that it's bottom up rather than top down. So first, people are looking at ideas, but the regulator is looking at ideas and then forming a framework, which I think is unique and first of its kind. I'm very happy that it's bottom up rather than top down.